Welcome to the SNN Network virtual conference. I'm your host, Robert Kraft, and thank you all for joining this panel. What we have going for you today, this is like legal panel part 2, as we were joking on this before coming on the call. And the title of this panel is COVID-19 Impact, What's Next from a Legal Perspective? And we're so excited to have back as our moderator, Jenkins from Harter, Secrest, Emery. And we'd like to thank all of our sponsors for this panel. That includes FitzGerald, Kreditor, Lynne, Bolduc. We have also Alixe, Cormick from Venture Law Corporation, and then Alexander McLean from Harter, Secrest, Emery. And with that, Jim, I'll throw it to you.
Thank you. I'm going to get a little granular on the introductions because we have a pretty impressive panel, which is always the case when we work with Bobby and his crew. We'll start with Lynne Bolduc. Lynne started her career as an in-house investment with the investment banks working in-house. She's now been a corporate and securities transactional attorney for over 25 years and has structured and advised on more than $1 billion worth of financing and business transactions, both private and public offerings and M&A. She's a partner at FitzGerald's Kreditor, LLP in Irvine, California, a business transaction and litigation law firm founded over 35 years ago. Alixe Cormick, who's also joining us and is at least new to me on the panel, is a lawyer and member of the British Columbia Law Society, the Canadian Bar Association, and the American Bar Association. She started Venture Law Corporation in 1996 to focus on providing legal services to MicroCap and small cap private and public companies. She's personally been involved with assisting over 150 companies listing on stock exchanges and trading boards in North America, and the sale of over 100 private issuers, primarily in the tech and biotech spaces. She's been involved with a number of private and public offerings, reverse takeovers, spinouts, mergers and acquisitions, leveraged buyouts, and other corporate combinations for companies both public and private. She's active. I went on her website and took a look. She's very active public speaking, in particular on some of the topics we're going to talk about today. I'm also pleased to introduce my partner, Alex McLean. He's the chair of my firm's Securities and Capital Markets Practice Group. He counsels domestic and foreign companies of all sizes, ranging from early stage startup companies to publicly traded companies with market capitalizations in the tens of billions of dollars. He helps clients successfully raise capital both publicly and privately while navigating complex federal and state securities laws, New York Stock Exchange and NASDAQ listing standards. He also advises public companies regarding their public disclosure obligations, including advice regarding both contested and uncontested proxy solicitations and tender offers. He's a trusted counselor to boards. He's helped them navigate corporate governance issues, fulfilling their fiduciary duties, and complying with federal securities laws. He also represents a number of investment banks in connection with public and private offerings and FINRA compliance. And since I'm the only guy with white hair on the call, I'm Alex's partner. I've been around a little longer than he has. I do pretty much what Alex does, except I have a lot more white hair. So with that, I think what I'll do is, before we sort of get into the nitty-gritty meat and potatoes, I just might want to ask around the crew here. And Lynne, you and I had this discussion when COVID first hit. I frankly was surprised by the number of deals that were going on and the number of transactions that are getting finished. So Alixe Cormick, I'm going to ask you, I mean, how are you seeing still a lot of activity where you sit?
Yeah, so I think we were having a fairly strong beginning of the year up here in Canada. And then everything kind of slowed down or shut down because the markets, if you can't price something, the only thing really that you can do is debt. And so we were seeing kind of a switch over to a debt market primarily. PE and VCs pretty much disappeared. They kind of hunkered down and we're kind of looking at their existing portfolio and seeing what needed to happen. And then on the public markets, because you couldn't price, we weren't seeing really much activity there. But that really picked up May, June. Really kind of blockbuster in terms of number of deals that closed and just kind of activity in general.
That's good. That's good to hear. I mean, I think we're seeing, anecdotally, I think, at least from where we sit in the U.S., we've actually seen some really consistent activity. I will say that the private equity side and I'll defer to Lynn and to Alixe on this, but my experience has been that if they had deals, they closed them, but they're sort of waiting now as to see what's happening with valuations. But I don't know whether you might disagree with me, Lynn, but I think we've seen robust activity both in M&A and in the public markets. I have not seen as much on the private equity side.
I couldn't agree more. It's the privates that slowed down. I have an IPO that it started before the pandemic hit, and it never stopped. They never postponed it, they never canceled it, and we're set to price on Monday. They did over 50 virtual roadshow presentations, and that's more than you could do, in person.
Mm-hmm.
So I actually think it got more traction because they were doing it virtually.
Interesting. Alixe, McLean, I know you've been very busy because I can hardly get a hold of you. So maybe you can tell us a little anecdotally how things are going.
I mean, similar to what others on the panel have been saying so far, I think what's going to be really interesting coming out of COVID is, the traditional playbook that we've all followed for IPOs or even for follow-on offerings and overnight deals. There's been a great acceptance of what Lynn was talking about, the virtual roadshow. And I know a lot of the investment banks I've talked with, their brokers aren't going to have as much of an interest anymore of schlepping into Midtown Manhattan on a Friday to sit through a couple roadshow presentations as they would have before. And they might be more inclined to sit at home and do those from the comfort of their own home. So I think it's going to be interesting over time to see if we start seeing a shift to more virtual type of roadshows. Because from what I'm hearing from some of my investment banking clients, is the feedback they're getting from their broker network is that's what people prefer actually. It'll be interesting to see once the world gets back to normal, how much of the more traditional face-to-face roadshows there'll be. But I get a sense it's starting to move more and more virtual.
Well, it's interesting. Everything seems to be virtual. I think I recounted for the panel the last time that I sit on the board of a public company, and we had some inventory towards the end of the year when COVID hit, and the accountants got quite creative and actually used drones in connection with inventory counts when they weren't prohibited when they were prohibited from getting into certain places. They ended up using drones. So I think the idea of going virtual in a lot of different ways may be the new normal. So with that, I think what I'd like to do is start with Alixe Cormick, and maybe for those of us who have cross-border, and I know my firm does, and I know Lynn's been involved as well. But Alixe, where you sit, how have the Canadian regulators responded to COVID? Have they responded in a way similar to the SEC?
I would say somewhat similar. They had, the first was kind of a blanket relief for regulatory filings. So they did one that was 45 days for pubco companies, 60 days for investment firms. And then they extended that out for a second time. So they've done round two. So basically first quarter, second quarter. For some people, their year end and their first quarter. Then also with annual general meetings. So they provided some guidance in terms of having electronic meetings or Zoom meetings or however you want to do it. And then also in terms of filing requirements for executive comp and things that you would normally see in those type of disclosure circulars. So those temporary reliefs that have been in place, they'll be coming off shortly. And so we'll see what happens for the next round, because of course, COVID is keeping evolving all the time, both in the United States and Canada. They also made some concessions in terms of mutual funds, in terms of allowing them to have more debt on the books. That actually comes off on July 31st. It was an April to July type period that they had. They provided similar type of disclosure to pubco companies, saying that in your Qs, your Ks, your press releases, you need to have balanced disclosure, including disclosure about COVID, no over exaggeration saying COVID's hurt our quarter or year end, or vice versa, just having nothing in terms of statements on that. And then they've also reminded investors of, and I'm sure you guys as well, for a period there, I was probably getting 2-3 calls a week on people who had a COVID company that wanted to go public, but with no real business there.
Yes, it was the new blockchain.
New blockchain, new things a month. So those were kind of the main things that they put in place up here, which I think are similar to what the US did.
Yeah, that's, have they had any enforcement actions against anybody who sort of suggested they had the COVID cure?
Oh yeah. We've had a couple. Yeah, we have. And you know, some of them also have kind of a cross-border feel where the SEC and the Securities Commissions up here are taking action together. But we've had, I think, 3 that I'm aware of. We may have more that are kind of sitting in the background waiting to go.
Okay. I asked you earlier, but maybe you could get a little more granular about the Canadian public markets. You suggested now that they're sort of back in full swing. Are you able to price deals?
Yeah, we're able to price deals now, which is great. So the CSE added 45 new listings in the last 6 months, 23 mining companies, 9 cannabis hemp companies, 6 tech, and about 7 from other sectors. And they've raised about 1.7 billion over the last 6 months in 521 financings, which is up from over the last year's Q1, but down from the last 6 months of 2019. The majority of these financings occurred in May and June, as we talked about before. The TSX Venture Exchange and the TSX, so the TMX group, they've had similar types of numbers in terms of, if you exclude, however, the ETFs, capital pool companies, and funds, there are about 40 companies which listed on the TSX and TSX Venture Exchange over the last 6 months, 4 of which were US based. So we have like Global Crossings Airlines, Real Brokerage Inc., Spectra 7, and Brookfield Infrastructure. So again, we're seeing kind of cross-border activity as well.
Oh, interesting. Yeah. And have you seen, I'll ask about cannabis in a second, because we actually have I have a friend who's now the CEO of a cannabis company up in Canada. But I'm just curious, have you also been in the U.S., Canadian companies been in the U.S. looking for money? I mean, if you weren't able to price, was there a sort of a shift? And let's go see if we can get money in the U.S.?
Yeah, so people have been raising capital in the U.S. And so, you know, you take a look at the Reg D filings. So 506 has always been popular with Canadians. There's been over 500 Canadian companies, unique Canadian companies, that have filed Form Ds with the SEC indicating that they're raising capital. We've had 10 Canadian issuers file Regulation A offering documents with the SEC, which is the most we've had in a 6-month period. Last year's Canadians raised about 19 million US using Regulation A. We have about 25 Canadian issuers that have filed Form F1s and about 35 that have filed S1s. So Canadians are definitely thinking that they're going to be raising capital down in the States. One of the private equity companies, so what are the names? Sorry, Crest Rock Partners out of Denver. They made a 52 million US investment in a BC company called Onbounce, a tech company, and that just closed, I think, a couple of weeks ago.
Okay. Yeah. So switching quickly to cannabis, I guess, are they still raising money? Are US cannabis companies still trying to raise money in Canada? Or
cannabis and hemp right now, there's over 100 US based cannabis companies listed on the CSE. And in the past 6 months, 9 new cannabis companies were listed, as I said before. 6 of them have their primary operations in the United States. These new US listings include companies like Columbia Care, which is one of the largest multi-state operators. They've raised the most, I would say about 40 to 50% of the capital that's been raised on the CSE in the last 6 months, over 147 financings, raising 1.26 billion for cannabis and hemp. This includes like 300 million term loan facility that was raised by Curaleaf during the last 6 months, which was debt. So debt still is a strong kind of preference in terms of capital raises, both in the public and private markets.
So I assume the rates in Canada are quite low?
Our rates are pretty much zero. So,
yeah. Yeah, it's interesting. We just, Alex and I saw a couple of deals, pre-pricing where the interest rate was almost zero on some of the bond deals. Very, very interesting.
Yeah.
I mean, if you're going to raise money in debt, I guess now's the time.
Yeah, but debt still is problematic, right? So a lot of companies, if you are kind of just building in the building stage, you still have to figure out how you're going to pay it back. And so a lot of the cannabis companies, I think in 2019 and even in this quarter, we're going to see a little, more bankruptcy and more pressure in that area for companies that weren't able to raise when they needed it.
Sure. Well, so, going across border, I guess I'd switching topics a little bit. Lynne, I guess I'm going to ask you a few questions. We know that the SEC has given some some significant guidance regarding COVID disclosures. Can you provide a specific recommendations in light of how the SEC has responded to other public company disclosures?
Sure. In our first panel presentation, we talked about how to disclose, but now the SEC has been looking very, very closely at all of the COVID disclosures that are being made. It's their hot button right now, obviously. And they are issuing comment letters to companies, at least in the US, about their reports and their disclosures. It is not enough to have a risk factor, even a specific risk factor, just in the risk factors section. The SEC has reached out to several public companies and asked for disclosure, extensive disclosure, in the management's discussion and analysis of financial condition and results of operations section as well. How exactly has the pandemic affected your financial condition and results? So disclosing the risk factors, disclosing the MD&A, something that is being considered right now by a lot of companies. Do we need to make a disclosure in the financial statements as well? Do we put a subsequent events footnote in the financial statements? And who drives that decision? The audit firm, the issuer? So that's sort of the new topic. And my recommendation is, when in doubt, disclose. It can't hurt you. Yeah. Disclose, disclose, disclose. And something interesting that also happened, the SEC issued several comment letters to companies, and they said, your disclosure regarding COVID is almost over disclosure. You're blaming everything on COVID. You are blaming your poor financial results exclusively on COVID, but we think there is something else, inherently with your company. It wasn't just the pandemic. So conversely, while we want to disclose the risks and the possible impact on the financial statements, you can't go overboard. You can't blame every bad thing that happens in your company on COVID. And some companies did that.
Yeah, I mean, sometimes your business plan you just didn't execute.
Right.
And that's a tough discussion to have with a client. And it is a convenient time to blame COVID. And I have a lot of sympathy for those in the retail space and the restaurant space, because I think COVID has significantly impacted their business and required them to get quite creative. We've had several sort of restaurant chains that we represent who are looking to raise money, many of whom turn themselves into delivery companies because the Instacarts of the world, the Grubhubs of the world were so overwhelmed that it generated a competitive opportunity. So, there is something to be said for continuing to look at something like COVID as potentially an opportunity as well. But it certainly is, to your point, Lynn, shouldn't be a crutch.
Right.
So that was helpful. I'm going to skip around a little bit. I might talk to Alixe McLean briefly, just have you talk a little bit about, because I think we've all seen this, and maybe we could even all sort of chime in on this. If COVID has caused a decline in the company's stock price, what considerations should a company and its board make when deciding whether to adopt the poison pill? If a company adopted a poison pill this spring, should the board have in mind when deciding to rescind or obtain stockholder approval for the plan during the spring of 2021? We've had, I don't know about you folks, I've had several clients who have taken the poison pill off the shelf. It has been a time where a lot of stock prices, particularly in the MicroCap space, have declined. I keep listening to the talking heads on TV telling me that most of the increases in the marketplace in the S&P and in NASDAQ are really among the sort of the tech giants. So my MicroCap clients have all sort of looked at protecting themselves, and some have had activist shareholders sort of snoop around. So I'm just wondering, Alixe McLean, maybe you could talk a little bit about that, and we'd open it up to the group.
Yeah, so poison pills are nothing new. They've been around since the 80s, when they were used quite heavily. They've kind of fallen out of favor in recent years as a result of the influence of proxy advisory firms like ISS. But I think as companies have kind of evaluated the impact on their stock price of COVID-related news, it's led to a discussion about whether they're now more vulnerable than perhaps they were in the past, where they're sitting at a market cap that maybe doesn't fully reflect the future value of the firm once this pandemic ends. And whether that opens the opportunity or the door to activists to come in and try to swoop up or buy the company at a basically at a very discounted price, especially now that many public companies don't have the traditional defensive mechanisms like they once had as a result of the influence of the proxy advisory firms. So I think what we've seen companies do is you evaluate two things. The first thing they evaluate is whether the decline in their stock price is temporary, if it's just going to be a short blip related to the pandemic, or whether if they're in an industry, let's say the hospitality industry, where it may take the hospitality industry or the airline industry or some other kind of similar industry, maybe years to come out of this, whether that's something that, whether that's appropriate for a poison pill to kind of resolve. And what they're looking at doing to try to bridge the gap a little bit. So one of the things I've been advising a lot of boards about is many people are concerned about what ISS and other proxy advisory firms will recommend as far as voting recommendations against the directors if they adopt a poison pill plan. But I think what I always come back to, at least for, under state law, is the fiduciary obligations of a company and the decisions about what's in the best interest of all the shareholders rest with the board, not with a proxy advisory firm. And if the board has reached the determination that there is a real threat that's been identified that could harm the shareholder franchise, that the appropriate thing to look at doing is maybe look at adopting a short-term poison pill. So this could be a poison pill, maybe a one-year term to it. The next annual meeting, either it'll be voted on and approved by the shareholders, or it will essentially go by the wayside. And the benefit is of adopting a poison pill is it serves as a real deterrent from anybody to try to come in, an activist or somebody else to try to come in and kind of swoop in and buy the company or execute a tender offer for the company without going to the board first and trying to negotiate the purchase price that might be in the best interest of the company's stockholders. So, what we're seeing is companies have gone in, especially this spring, and started to adopt these kind of poison pills. They've made sure to kind of disclose their rationale to that to the investor community and so that ISS and others can kind of understand why they're doing it. And then I think as we look to go into the spring of next year, what companies are going to have to evaluate is, has their stock price recovered? I mean, part of this goes back to none of us can predict what COVID's going to look like in March or April of next year. But assuming, hopefully, that things are getting more back to normal, there might be an idea of just letting the poison pill lapse because the market solved the problem by recovering the stock price. If they're one of those companies that are in an industry that's been hard hit, it's going to be a very difficult decision about whether you take that to a stockholder vote to try to get your poison pill, approved, or whether you try to put it in place without stockholder approval or keep it in place without stockholder approval and run the risk of, a withhold vote campaign by ISS and some of the other proxy advisory firms that, could publicly embarrass some of your directors. And I think with that, there's no easy answers, but I think a lot of it's going to be around communication, whether you're able to communicate clearly to the market about why you've adopted this mechanism to protect the stockholders and to ensure a fair price for the stock. And, if you don't do that, I think you do run a real risk of some negative reaction from some of these proxy advisory firms.
Oh, well put. Now, Lynne or Alixe, Cormick, have you seen sort of similar circumstances with some of your experiences? And Alixe, Cormick, I wonder if you're seeing the same kind of activism that we're seeing in the US and Canada.
Yeah, our proxy firms that we do have kind of proxy solicitation firms, but they're not as active as I would say on the US side. That's really something we've seen, I think, in our generation in the last 20 years, kind of grow up from being almost non-existent in the 80s and 90s to being more and more kind of activist oriented in the last 10 years in particular in the US. In Canada, there's been a little bit of that. We use poison pills on a regular basis, but usually it ends up being a protective mechanism. We have quite a bit of regulatory case law or disputes that have been put in front of the regulators in terms of why that was put in place. I've got about 3 clients that are what I would call micro clients that currently have a poison pill, but they put that pre-COVID in place. I haven't had any clients say that they want to do that, although you take a look at kind of their market price. Like I have got several clients that are trading less than what they have for cash in their bank account.
Yeah.
Makes them ideal targets, right, for something like that. We've got other mechanisms, which is we're not allowed to do staggered boards up here, but what we do have is we have like a heads up you can't just appoint someone from the floor. And that's something I used to do on a regular basis, particularly when brokerage firms weren't happy what management was doing. You'd basically vote a new slate from the floor, having approached 5 individuals, sort of thing, with a large block. So I'm expecting that we will see quite a bit. We have seen quite a bit of takeover activity, but a lot of bottom feeders in terms of really low pricing for what they're looking for.
Yeah, we're seeing that, and the SEC just adopted some revisions to their Schedule 13F filings that's going to remove the company's ability in the U.S. to really see who's accumulating shares in the shareholder base. And Alixe, McLean, maybe you could describe a little bit of that, and then Lynn, I'll get back to you on a couple questions I have for you, particularly as it relates to M&A.
So yeah, the SEC, you can't say they don't learn from the issuer community, because they dropped a nice press release at 5 o'clock on a Friday, and it was a very controversial one. So I mean, you could tell they kind of learned about how to time a press release on a summer afternoon. But what they proposed is to reduce the number of investment managers that have to file 13F. So for those who aren't familiar, a 13F is a disclosure that an investment manager has to make if they have $100 million or more of investment securities in their portfolio. And what they have to disclose is basically on a quarterly basis what their holdings were. And that's reported right now 45 days after the quarter end as they provide that. And the purpose originally that the SEC had for adopting that in the 70s was to provide information to the SEC for their purposes in evaluating kind of the large investment managers and what they were doing. But what's happened over time is more than just the SEC is relying on those reports. As you mentioned, Jim, now many issuers, in particular MicroCap issuers who have a limited window into their holdings, rely on those reports to determine who's kind of coming in and out of their stock. And it can help, set some early alerts if there's an activist or somebody else coming into the stock. And so what the SEC did is the $100 million threshold was set in the mid-70s. And so all the SEC did was kind of inflation adjust that number up to where it should be now, which is, I think, roughly around $3.5 billion. But the practical impact of that is it greatly reduces the number of investment managers that have to file these reports. And I think NIRI, the National Institute of Investor Relations, they've been outspoken about this. And I think what many people were hoping for, I think everyone recognized a lot's changed since the mid-70s. There needed to be change in 13F reporting. But the SEC just picked one aspect of it, and they didn't kind of update the 45-day requirement and accelerate that. They didn't require including your short positions on your 13F reports, and they weren't really thoughtful, or they didn't really take into consideration that someone other than the SEC was using these reports. And I think because of that, you're seeing a significant amount of pushback from the issuer community right now. Now, these were just proposed rules. We'll see where it ends up when it gets to final rules. I wouldn't be surprised if the proposal changes, given the significant pushback they've received. But it's definitely caught the interest of a lot of public companies in the U.S. and investor relations firms who are kind of recognizing that if the number of funds that have to provide this information is cut by, and I think it's something around 90% of the number of funds that have to report this. The dollar value, most of the dollar value is represented by the larger ones, but the number of funds, if you cut that out, particularly for small cap and micro cap companies, where many of the institutions that invest in those kind of companies tend to be smaller, you're just going to have a real lack of information that issuers are going to be confronted with if this proposal actually goes through.
Yeah, again, I represent companies a lot for the most part. I don't represent a ton of activist shareholders, so I'm going to express my bias, and my bias is that it seems that the SEC is much more, they're certainly tougher on issuers and registrants than they are on shareholders. But so it sort of gets me to the next topic, which is, so you've tried your poison pill and decided you didn't want to do it. Somebody got sneaky on the 13F with the new rules, and now they're driving the company to an acquisition. And Lynn, the question, of course, is, prior to COVID, if the company has now turned itself into a distressed asset or a pre-bankruptcy asset, do the disclosures to the investors change, or they certainly need to be updated in one way or shape or form? And how much pressure is placed on a sponsor to bring in additional management or consultants that specialize in distressed assets. Maybe you could give us a little bit of pointers and maybe some experience.
Sure. In our first panel, we talked about how M&A deals were getting sort of the COVID discount or the COVID haircut, and where substantial discounts were being required on the purchase price. Now that companies are into the acquisition and the assets are still suffering, yeah, the investors should be aware of all of this already. If they are not, make them aware of it. Again, we go back to the point, you don't want to do it, but disclosure will set you free. Disclose to the investors. Second thing to do, call in the specialists. If your company is suffering, A, your earnout, you're not going to make your earnout. And B, I mean, the risks are huge. This is the time, sort of like the government is throwing money at the problem. You need to throw money at the problem in your acquisition now. You need to get the turnaround specialists and all of that. It's worth it. And C, something that is going on a lot with my clients lately, I represent a lot of PE funds, and a lot of them have pivoted and they dropped their prior funds and now they're distressed asset funds. So now they're going out, acquiring all these distressed assets, mostly hospitality, retail, but also real estate, parcels of raw land where things were going to be built. And there are investors who have an appetite for that. So worst comes to worst, you could sell the company, albeit it's going to be at a big discount, but you could recover something to the point of the investors in this acquisition. Distressed asset funds.
Well, you know, that gets me back to it. How many on the panel? So we had, you know, when we were last chatting, Lynn, you know, the payroll protection program was in place, and you know, technically public clients were certainly eligible to participate. And over time, the SBA kept pronouncing things. Does anyone on the panel have clients that took payroll protection program loans? We had clients who were on the verge of taking them and then decided not to based on what was happening in the public opinion front. But does anyone else on the panel have any experiences with anyone who took that money?
I have private companies who took the money.
Yeah,
not public.
but no public ones.
I have one public company who's kept the money, and I had several who kept in return or took in return, and then some who backed out. But I have had, and it's a very small company, and the amount of the loan is well below any kind of audit threshold. But you know, there was some initial very strong pushback, particularly from the media and others, and even from the administration. I would say it's wavered a little bit recently, and particularly if you're talking about a truly small company and a very small loan. You know, I don't think the pitchforks and torches are out quite as much as they were maybe a couple months ago.
Alixe, Cormick, did they have a similar program in Canada?
Trying to get myself on mute there. So yeah, we did. We had similar programs and things like that. None of my clients took any of those funds for various reasons. Not some of it because it was difficult to understand how that was going to get repaid. What part was kind of a, you know, waiver forever type thing. And they just decided they didn't need the money because they were cashed up. I was fairly lucky in terms of my client base being cashed up. But yeah, we didn't, but we have similar kind of programs up here.
Yeah, no, Alixe and I had a joint client who came very close, I think, to taking the money. They had a lot of cash on their balance sheet, but you know, they're a biotech company, so they could have burned through that. They were going to burn through that money, and then decided it just wasn't worth the aggravation. You know, but I guess you know, a question back to Lynn again in terms of, and we could all sort of join in on this because I think we've had, I certainly have had some experiences where the pandemic hit and I had at least two clients who immediately drew down on their entire line of credit because they had concerns with liquidity and then worried about dealing with the bank, you know, later. And we're now in the midst of doing that right now. And that comes to a question for you, Lynn. You know, when should a company notify its lender regarding any impacts on the business? For example, a typical event of default, you know, is the suspension of business. Would an involuntary suspension of business, you know, based on what's happening now out there, triggered this kind of provision? And what's sort of been your experience with that?
I had one client in the early days of the pandemic request a $5 million drawdown from their line of credit, and it was refused. The bank rejected it. They said, no, we're having too many PPP loans. We don't trust the economy right now. They didn't get their $5 million, even though the bank had previously promised, here's your line of credit. And, the bank got off scot-free, so to speak, with that. So now what we're having is businesses suffering. When do they tell their bank? Is this an event of default on their part? And I say you don't want to do it again, but stay in communication with your lenders. Let your banking contact know what's going on. Something else that happened over the last 30 days is my client notified their bank that they were in distress. The bank declared an event of default on my client and said, you didn't notify us soon enough. You should have notified us earlier. That's completely subjective. We're fighting it, but it did happen.
Well, so I'm going to sort of survey the panel again on that, because I can tell you that when the pandemic hit, virtually every client that I had was pounding on the door of their banker, their commercial banker, to talk about covenant relief, more favorable terms, access to liquidity. And some banks were more responsive than others, but just surveying the panel, I mean, what was your experiences when, and frankly, they're ongoing at this point. I mean, we're still in the midst of companies with liquidity issues. Just curious, as other members of the panel, what your experiences have been with the banks.
So maybe I'll start off here. I've seen a couple of different approaches, but one approach I've had several clients use, and these are kind of the larger clients, but immediately when the downturn happened, they drew down, in some cases, hundreds of millions of dollars off of their credit lines. And then what they did is, a few weeks or a month maybe goes by, and, they get to see a better sense of where COVID-19 is going. And they come back to their bank and say, we need covenant relief because we got 300 million and you're not going to get it back if you don't give us some covenant, relief out there, whatever the number was, it's a significant amount. And so now the banks are, they negotiate an amendment to their facility to get their covenants into a place where they feel much more comfortable with the financial covenants. And what I've had many do is now return a lot of that money back to the bank, pay down the loan, so they're not paying although interest is very low, many of them are starting to pay back that money with the understanding that now they still have it available, on the line again, but they have much more favorable debt terms. So I think, we're, at least what I'm seeing is companies are being, and this goes back to what Lynne was talking about before, companies who have had very good relationships with their banks where there was maybe a little bit of competition for that work. And they've utilized that to keep the banks completely in the loop. And as a result, been very upfront with the banks about what they're looking for, whether it's drawdowns or whether it's amendments to kind of provide temporary relief on some of the financial covenants in the terms of the credit facility, at least to get the companies kind of through the COVID pandemic until they kind of get their businesses normalized again.
Alixe, Cormick, how about your experiences?
Cannabis companies don't have bank lines of credit, first of all, so they don't have that problem. Some of them did have, alternative lenders, and some of those alternative lenders turned on them, in part because cannabis was going through a rocky period as it was at the end of 2019, with a number of kind of failures in terms of reporting the returns people were looking for. So they had quite a difficult time, I think, at the beginning of the year, and that just kind of accelerated for some, and for others, like I said, they were cashed up. On kind of, biotech and tech up here is a little bit different. So a lot of them get monies from BDC, which is almost like a backed government bank. And so those are a little bit more lenient in terms of trying to keep people around and things like that. For the major banks in Canada, I think most of them have tried to work with their client base, including the smaller ones like restaurants and others that are kind of in distress. At first, that wasn't the case. We were getting kind of a lot of people, friends and things like that in various parts of the private industry, just saying that their clients were being slammed by the banks, that there was no kind of consideration at all for kind of the situation they were in. The larger players, most of them have reworked their banking arrangements in terms of their debt. So that's kind of what we've seen. But again, certain parts, some people don't have any banking issues. So
You know, it's interesting because you have the Federal Reserve here in the U.S. anyway, pumping just gobs of cash into the market. And so in our little microcosm here, we've had several clients who are negotiating they're for instance, commercial real estate. They'll be negotiating forbearance with the bank while their tenant is negotiating, a delay on rent payments. That works for a while.
Yeah.
I just wonder how much longer that's gonna be able to work. We have a Main Street loan program here that the Fed instituted, as well as a similar program with the Small Business Administration. I don't get the impression, Lynne or Alixe, that those have been terribly well received, certainly in the microcap space, even with companies with cash flow. They simply don't fit within their existing lending arrangements. Not sure if you guys have run across anything, but I certainly haven't seen those programs come to fruition in any way, shape, or form.
No, I mean, I think a lot of them there hasn't been enough guidance from the SBA and others around what those programs even consist of. And, many of them could conflict with a company with, bank arrangements. And there's also an open question about whether many, particularly early stage companies, would even qualify for them. At least from my experience, I haven't seen a lot of companies express a lot of interest with it. Initially, they were intrigued, but it was always the waiting game, waiting for further guidance. And it's just been very slow in coming. But I don't know if Lynne has different experiences.
No, I agree with you, Alex. Most of my clients never even heard of the Main Street Lending Program, and I've only had one bring it up to see if they could take advantage of it, and it hasn't happened yet. It wasn't like the PPP. Everybody jumped on that bandwagon, but this follow-on opportunity for lending, just has not received the attention like the PPP did.
Yeah, so the avenues for liquidity for the microcap, at least our experiences, we have seen mostly equity financing and a lot of what I would describe as overnight deals. Alixe, maybe you can talk a little bit about that, but I think the confidentially marketed public offering and the registered directs are things that we certainly have been seeing a lot more of them in the context of COVID.
Yeah, and it once again, this has served as a good reminder to particularly companies who are listed, who have their stock traded on NASDAQ or on the NYSE American or even the NYSE, that if you're in that position, now is not the time not to have a shelf registration statement on file and effective. And also now is not the time to make a boneheaded move and miss an 8K filing that is an easily preventable error, because those little blocking and tackling kind of items can really leave you vulnerable right now. Because if you're in a position where you're an early stage company, maybe in the biotech space, who relies on funding to move your operations forward, and you're in an environment where really the only thing open to you is equity financing, and the banks are doing deals right now, but if you don't have an S3 available to you, or if you're ineligible because you missed an 8K, you can't go try to get a waiver from the SEC. That takes time, and you're just putting yourself in a position where you might not be able to fund your business. So the markets are definitely active, but what I've been really cautioning people is, if you have a need for the money, do it now. Why wait for the markets to turn and for the markets to close down? If you have bankers and you're going to have a cash need, you might as well, get out in the market and try to do something while, there's a lot of activity in the market.
Yeah, well put. So I guess the other sort of question for the group, and look, we've had COVID hit. We've had various efforts within North America to address the liquidity issues that have run from shutting down virtually most of everybody's business for the last several months in North America. I guess, has anyone run across, because we used to do a lot of deals, Chinese deals, with Chinese companies, and those have dried up. And I don't know what the future might show for those. Alixe, Cormick, I don't know whether are the Chinese looking to Canada, or is the relationship in the Canadian market similar to they would be in the U.S.?
So it's certainly we're getting more calls from people that are looking to kind of look to Canada versus the U.S. The sentiment right now with the Asian market is that the USA is unfriendly to listing, even some of the companies that are already listed on the US markets that are fairly large are looking to see whether it's viable to either move to Canada or the UK and abandon the US altogether. So definitely that's something that's live. I actually quit doing China deals in 2008 when I started seeing deals that didn't make sense, and that caused all of the problems that we have. I just wouldn't do them anymore. And I did the first 6 deals on the China board of the old Vancouver Stock Exchange. There were only ever 8 China deals that were listed on that, and I did 6 of them. I've probably taken about 20 China-based or Taiwanese-based companies public in North America. I was involved with $1 billion financing of a Hong Kong-based company that listed here in North America and co-listed in the UK. And certainly that's a different market altogether. They're a lot more sophisticated. Most of them want to be in their home market. So one of the companies that was looking to list in the US decided to co-list in Hong Kong and Beijing at the same time. And they bypassed Canada after taking a look at whether that made sense for them.
Okay. Alixe and Lynne, I mean, it's pretty much dried up in the U.S. Although you know, I don't know where that's going, but I do get the sense that there's a frosty relationship between our listing exchanges and Chinese corporations.
Yeah, I would say it's going nowhere is where it's going. You know, I mean, to be quite honest, you know, for better or for worse, as Alixe was saying, you know, 2008, 2009 could have been kind of the death knell for Chinese listings. I think there's many people, you know, our firm was similar to her, where, you know, we decided to take a pass on that kind of reverse merger kind of, you know, IPO kind of phase that they went through. I think really what it comes down to, I think for the time being, I don't think there's a lot of opportunity for Chinese-based companies to list in the U.S. I think to the extent it does open up in the future, I think it's going to require some significant changes from a governance perspective. They're going to, if there's a Chinese company that truly wants to adopt U.S.-style corporate governance mechanisms, including independent boards, you know, limitations on related party transactions, transparent audits. You know, a company like that, theoretically in the future, sure, you could be listed, but you know, I don't remain very positive or confident that there's going to be a lot of movement there in the short term. I don't know if Lynne, you have any different thoughts.
No, I agree. It's the same.
Well, you know, Alex Cormick makes an interesting point though, and that is that if the, you know, you're not, the growth in Asia is still coming, right? It's still going to be a growing market. And if the attitudes towards the exchanges in the U.S. are, you know, they're not friendly, which is, I think, the correct attitude at this point, that money's going to go somewhere else. I don't know whether that's a good thing or a bad thing for the U.S. exchanges, but it is a side effect, I think, of COVID has been this frosty relationship that I don't think, certainly COVID hasn't helped.
Yeah, here in Canada, we'll welcome Chinese companies. We love them. We have a good relationship traditionally with China companies. We have slightly, like our response was slightly different. The exchanges here require like a sponsor. So if they're going to do an RTO coming public, they have to get an underwriter sponsor that basically writes a report, boots on the ground. They also have kind of accounting requirements and things like that. Although I would say it's probably difficult to enforce what they've kind of put in place, but they do at least have something in place saying this is how you have to do your accounting. This is what we want to see in terms of your corporate governance and things like that. And there have been successful listings of China companies here in Canada. And we also, because we do have a micro-cap market, we probably are a little bit more risk ready than a lot of the more major exchanges. So our equivalent to New York Stock Exchange, American, NASDAQ would be our TSX, right? So whereas the TSX Venture Exchange, you guys don't even have an equivalent to that. That's just like, it's a totally different part of the marketplace.
Agreed. I mean, listen, again, it smells a little bit to me. And look, back in 07, 08, when US was bundling financial instruments that nobody understood, they weren't doing that in Canada. No. So consequently, the Canadian banks came out of that, I think, pretty strong. I remember in 09, 10, companies seeking capital who could not access the U.S. capital markets were going to Canada. You know, and you wonder whether that's something that's a bellwether for the next post-COVID.
Yeah, and the talk is that, you know, the Dodd-Frank actually benefited U.S. banks this time around. that they're in better shape because you guys put that in place. Although it was unpopular, you know, a lot of people, not just myself, but a lot of people believe it's kind of saved your bacon down there.
Yeah. So I guess I have one last question. People can certainly chime in, but it just sort of, any thoughts anybody has, sort of the post-COVID realities, you know, both legal and non-legal. You know, Lynne, this is sort of something I think you and I had discussed. You know, how far can we ask a third-party vendor to provide information? How much impact do you think this will have in terms of renegotiating contracts, that kind of thing? Maybe, Lynne, you could walk us through a little of your thoughts on that.
Practical suggestions for the audience. Number one, moving forward, make sure all of your contracts list a pandemic specifically in the force majeure clause. Number two, a really practical suggestion for a small company, a large company, a business continuity plan, a BCP. That's required of registered investment advisors in the US, but I don't know if other companies have these, you know, regular private and public operating companies. Business continuity plan says what happens if the office is shut down because of fire, earthquake, pandemic, or what? Where are our records stored? Can people work remotely? Can people access our database remotely? Who's going to be the contact? How do we get in touch with each other? It's not a complicated thing. If you don't have a business continuity plan, get one. If you do have one, it's now been tested. How did it work? What do you need to tweak? Very, very helpful for your employees moving forward in uncertain times. There's always emergencies. And the last part of a business continuity plan, ask your vendors. Well, let us see your continuity plan. What happens if you can't go to the office? Can you still do the services that we need you to do to keep our business going?
Interesting take. I will say this, I know, because we represent a number of insurance carriers, they were tasking us immediately when this hit to take a look at their force majeure clauses, because I think they were nervous. Mm-hmm. You know, that kept our insurance group in business for quite some time. But yeah, those are interesting points. Anything else that anybody might have to add? And if I haven't asked a question that somebody thinks I should have, by all means, please chime in.
I mean, the only thing I would say just quickly is, you know, I think many companies, you know, when you come out of a crisis like this, there's always typically a flood of litigation. And I think Congress maybe take some action, and maybe that would limit this COVID-related litigation. But there's been a lot of backup in litigation right now. A lot of courthouses are closed. You can't even file litigation, or filing litigation is difficult. A lot of companies don't, or a lot of, you know, people who have been wronged haven't necessarily wanted to, you know, go out and start litigation with their own uncertain financial fortunes, you know, still uncertain. But I think once we come out of this pandemic, I think people need to be thinking about, you know, liability protection, looking at, you know, was there any data security breaches that occurred during this downturn? And if so, you know, what would damages look like? You know, do you have a good whistleblower policy in place? And if someone does blow the whistle to the government, perhaps related to the company's activities that took place during COVID, you know, what kind of response plan do you have in place for something like that? And also starting to think about, like, if you have a whole team of employees who've been seriously sickened by COVID while you were acting as an essential business, do you have potential liability to them? And if so, you know, how has your HR and employee relations been? You know, you would think this would be the time to try to strengthen those, to try to cut down on what inevitably is going to be a large amount of litigation, probably post-COVID.
I would kind of, you know, add to that and say that things that companies should be looking at is that your opportunities to raise capital, it's shorter windows. So Alex kind of alluded to that earlier, but you really need to be ready if you're going to need capital, and because your window may be as short as 2 weeks. I'm not kidding. It's a very short window nowadays. We have a very volatile market. We have short pricing windows. It's going to be really hard, again, if you're going to do a traditional public offering. We always kind of look at volatility in the market, and when the market's volatile, we don't have IPOs. And so again, going to how are you going to list, whether it's direct public offerings down in the United States, or doing RTOs or other ways, private placements are going to be kind of key for you. And don't load up too much on debt. Debt can kill you if you're not ready for it. I would also say to people, stop using Dropbox. You need to, it's not secure. You need to stop using it. You should have kind of a data room ready for, again, deals, acquisitions, opportunities, investment from large groups and things like that. Have everything up to date, but put it on something like sync.com. This is important for Canadian issuers if anyone's listening, because it can't be accessed by the US government. So if it's in Canada and you're not in the United States, the US government can't access that database because it's 100% in Canada. There's no US servers like Microsoft 365, which I would suggest would be a poor use as well. So you want to kind of, you know, and also with Sync, they can't do what Dropbox does, and it's pretty much unhackable. So you want to use something, take a look, contact your security advisor. And then on insurance policies, there's different types of insurance. What we've been seeing is that you can no longer get business, certain types of business insurance for kind of like pandemics or any other kind of breach of business type activity. But there are other types of insurance that you should be taking a look at. And I would suggest that you revisit kind of your indemnities as directors and officers and take a look at your direct D&O insurance that you have in place.
Terrific. Does anybody else have anything else to add? You know, this has been a terrific crew. Very much enjoyed your time and your valuable insights. And I just want to thank everyone for being a part of this, and hope we can do it again.
Well, you've been great, Jim.
Thank you all. And actually, I had one follow-up question that I thought I might ask the panel based on what I heard today. And one thing that stuck out, I think it was Lynne that said this about you can't blame everything on COVID-19. So there's a lot of investors that are watching this right now. What are some things that they should look for in either the press releases or the filings that may indicate maybe this isn't all COVID-19 related for the business faltering or having a downturn?
It's the financial statements.
Yeah.
And there's 3 things to look at. Number 1, look at the cash position of the company. How much cash do they have? To Alex Cormick's point, do they have enough cash? Are they cashed up, so to speak? Are they going to have to get financing? Is it going to be debt financing? That's what the cash position will tell you. Number 2, the bottom line. Are they profitable? If not, why not? Have they had a decrease in profitability over the last year, over the last quarter? What's really going on? It's not just COVID. Number 3, read the notes. The auditor's notes will tell the story of those numbers. So the cash position, the bottom line, and the notes. That's what investors should look at, not just the risk factors. Look at the risk factors, the MD&A. Sometimes risk factors are a lot of boilerplate and, you know, just required disclosures.
And to add on to that, those financials are going to show historical performance. If the historical performance was light pre-COVID, that's going to say a lot.
Yeah, no, I was just thinking like there's might be a few of those companies that never made a dime, and then all of a sudden it's like, oh, COVID. Oh,
right?
Yeah.
COVID just screwed up everything, and now it's
all COVID's fault.
Yeah, all COVID's fault, and you're just like.
Well, you know, the flip side of that, guys, is there are plenty of companies. I mean, I'm on the board of a PPE manufacturer. You know, we worked very hard to make sure our supply chain, you know, was available and remained consistent. Had we not done that, we would have been blaming COVID on our inability to be able to manufacture stuff to process and protect people against COVID. That would have been kind of a silly disclosure.
Absolutely. Well, real quick, can everybody give their websites for people to find you? So let's go counterclockwise. Lynne, Jim. Well, Jim and Alex are more or less the same. But
I'll let Alex give ours.
And then Alex Cormick.
We are F as in FitzGerald, Y as in Yap, K as in Kreditor, Law, LAW.com.
And I kind of wish we made Jim do this because I want to see if he actually knows this or not. But ours is hsdlaw.com. So H as in Henry, S as in Sam, E as in elephant, law.com.
And mine is venturelawcorp.com.
Awesome. Well, thank you all for doing this. This was amazing, as always. Fantastic panel. Look forward to the next one.
Thanks,
Stay
Robin.
safe, everybody.
Thanks, everyone.
Bye-bye.